Okay, great. So I'm going to start now. And thanks everyone for joining in so far. And I'm sure more people will be joining over the next few minutes. But hi, I'm Dede Eyesan, and I'm the founder of Jenga Investment Partners and also the portfolio manager. And just before I start, can you see the screen with the slides on? Please let me know in the chat. Okay, great. So yeah, we're Jenga Investment Partners. And for those of you who may not know about myself or Jenga or just knew about us, we started as an investment club in 2019. And now we're transitioning into an investment fund that will be registered in the UK under the FCA regime. And we have a global long-only strategy. So we look around the world for companies to buy shares in the public markets. And we have two strategies for now. So we have the South Africa strategy and the global strategy. But once we finish the FCA authorization process, we will only have the global strategy, and that would be for institutional clients. So that's a bit of background about Jenga. And the next slide, oops, going a bit too far, is the disclaimer. So this is very important. So before we start the conference, I have to share some legal information with you. So first and foremost, we are not trying to sell any securities to you. So please, before, if I mention any companies during the presentation, please don't buy shares there because you're likely to lose your money. And it's happened before. So please don't buy any shares we talk about. We're just giving a background of what we've invested in, and it's not for you to then go buy and sell shares. And furthermore, like I said before, Jenga Investment Club it's an investment club transitioning into an investment fund. So it's just important I share that with you. So yes, while we're an investment club, I set the mission of what we're going to achieve, what we're meant to achieve. And it's literally just one thing. Our goal at Jenga Investment Partners is to compound the wealth of the people who give us their money. So it could be friends, family offices, pension funds, institutions. Our goal is to compound the wealth by investing it in the stock market. And the way we invest, we'll talk more about that, but we use an absolute return view. And what that means is that we set a benchmark we want to outperform. And most times it'll either be the S&P 500, which is the US index, or the MSCI World Index, which is the global stock market. So that's our mission. And that's what we want to achieve for all our partners, growing your wealth over time. And in the last 2 years, I've been able to work almost within the investment fund industry. And over the last few months, I've been thinking really deeply about what Jenga has to offer that's not out there. So there are three things we're trying to solve. The first one is the underperformance of funds globally. So the statistic is about 6 in 10 funds will underperform the S&P 500. And over the last 120 years, the US market has averaged between 8% to 10% per year. So that's the target, 8 to 10%. And in any given year, you're guaranteed that at least half or 60% will underperform. So our first goal is to ensure we outperform the benchmark. So the S&P 500 or the MSCI World Index, we want to outperform that. So that puts us in the top 40% in terms of funds, and not just outperform the benchmark, but also outperform it by a large margin. So since we started Jenga, we've compounded at 27% gross returns, and that has outperformed the benchmark. I know it wouldn't always be 27 or in the 20s, but our goal is to really be in the top 5% of funds globally. So we have a high benchmark and we're aiming really high, and that's why we set up Jenga. So the second thing is the lack of youth. It's an interesting one because there's a common assumption that you need decades of experience You need to spend 10 years building slides in a bank, and then before you move into the buy side, and then you can actually be a portfolio manager. So common misconception is that it takes about 15 years to know how to invest. And I think it's wrong. And I think what Jenga brings to the investment world is our youth. So myself and Anna Curry, who's also on the call, but is not presenting today, she is an investment analyst. I think we bring youth to the industry. And by that, what I mean is we're young and we have a very fresh perspective about life. And when you look at the largest companies in the world, so let's say Tencent in China, you look at Apple, you look at Facebook, you look at Netflix, and even Amazon. If you look at the biggest trends they're all facing, it's young people. Tencent makes games. The average gamer is in their early 20s. Facebook, Instagram, WhatsApp, the average Instagram user is in the early 20s as well. And when you look at Apple, their highest profit margin segment is the App Store, which is mainly games. And you look at the airport, the average airport buyer is in their mid-20s. So the largest companies are being driven by trends driven by the Gen Z and millennials. And by next year, half of the world population will be either Gen Z or millennials. So majority of the trends will be driven by young people. So we as young people, we bring a fresh perspective, and I'll show you in the portfolio, we have quite a bit of creative ideas in how we think about companies. And again, that's the last point, that lack of creativity. The financial world has become a modeling thing where, before people want to buy things, they have to model everything, and they build a good picture of Excel spreadsheets with lots of numbers. But the problem is there's a lot of numbers, a lot of modeling, but not enough thinking. And I think that's what is the most important thing in investing, actually doing thinking. And with thinking, creativity is very important. So the way you see the world is really important. And I mean, one of the biggest trends for us is the transition from work to leisure. 100 years ago, there were, on average, people were working 60 hours per week. Now people are working 35 hours. And now with that fact, with just that data, we're able to infer 6, 7, 8 different investment ideas. And it's that creativity to take one idea into 8 different investments. And that's the creativity we bring at Jenga. So all 3 is what we are serving in the investment world. And we use these 3 things to really drive our performance. So yes, so before we look at the overall funds, I'd like reminding everyone of what our investment process is. And Anna and I call it the Jenga lens. And it's literally a 5-step process we use in investing in the global equities. So we always start off by understanding the business economics. And typically, we will use something like Capital IQ or Bloomberg to screen lots of companies. So there are about 25,000 companies listed globally. And of course, we can't analyze each of them. So we screen, and when we screen, we want to understand something. So we want to understand the business economics, what the product is, what the service is, how does it fit relative to peers. We want to understand the current profit margin and the current return on capital, and we want to be able to forecast that over the next 3 to 5 years. And lastly, we want to understand the growth potential, because we are growth investors and we want to understand the growth in everything we're buying. And then we move to the second area, which is the competitive advantage of the business. So many companies will have different forms of competitive advantages. So for example, Nike sells a commodity to you, but we don't really analyze Nike as a commodity. We don't analyze Nike as just textile company. We analyze it as a brand, and it's really that brand. I mean, when Nike make Air Jordan releases and they only 1,000 copies, and everyone's screaming to their phone at 11 a.m. trying to buy before it sells out, that's a brand, and that's the brand power. We're trying to understand the scale of that power before we make any investment. So that's the second stage. And then we move to the people behind the companies, which are the owners. So the owners and the management team. So in most cases, we invest in companies that are founder-led. And on the global portfolio, we have 16 companies. 13 out of 16 of them are founder-led. So the founder of the company still owns them. So for example, Facebook, Mark Zuckerberg, and the ones that are not founder-led, like L'Oreal, we have the founding family. So I think the granddaughter of the original founder of L'Oreal is the current chairman. So it's still close to founder-led. And the essence of that founder-led focus is because we want to invest in companies that have that owner orientation, that have that culture to succeed, they have that aspiration to make really great brands, really great companies. And that's the third thing we analyze. And then the fourth, when we put all that data together, we want to understand the intrinsic value. So we were looking at the future cash flow generation, and we put that all together. We want to understand the intrinsic value. And when we think a company is worth a lot more than what the market cap is, we like it, and we tend to buy those ones that we definitely buy the ones that are undervalued. And then we have a portfolio of about 15 to 25 companies that fit a criteria. So all the four previous points, and we put that in a portfolio, and we only buy the best ones we find. So I think this year, Anna and I, we've analyzed about 500, 600 companies, and we've only bought 60, or we only have 16 currently. So we could go from maybe just 1% of the companies we analyze overall, we would actually buy them. And that's because we want to ensure what we're buying is the best things we can find. And then, of course, we diversify. So we diversify the risk, we diversify across different industries and across different sectors. So again, this is the investment team. Myself, the portfolio manager, and Anna, who's been with us for a year, and hopefully will be with us for many more years to come. She's the investment analyst, and she works with me on the global strategy. And it's been a delight to work with her. But that said, we also have an operational team, and we have lots of service providers who are helping us out with the transition from an investment club into an investment fund. So we have a part-time COO, Anil Joshi, and we also have, we're going to have a part-time CCO, and the legal team is led by Evershed and so many other service providers. So there are many things happening, building Jenga behind the investment team. So it's not just us at Jenga, there are many things happening, and but we are just the investment team. And in the next 1 or 2 years, we plan on adding 1 or 2 more people into the investment team. And we'll talk more on our plans for the next year. So just to kick off with the South Africa strategy. The South Africa Fund was the first one we started in October 2019. And I'm not South African, and Anna's not South African, but we decided to start in South Africa for a very good reason. When we started, the world overall had gone through 9 years of an economic boom. So we were growing, recovering from the financial crisis. And the goal was that when we started, we didn't want to invest during an economic boom. We wanted to invest in an economy that was in a recession or had slow growth. And the point of that was that we got the opportunity to test our investment strategy in a very different climate. Most times, long-only funds don't do well during a recession. So we wanted to put ourselves pretty much in the deep end and see how we will do in an economy that's not booming in terms of economic growth of 3-4%. So at the time, South Africa had just gone into a double technical recession. And if you're on the news and reading anything in South Africa, you would have seen quite negative things by economic analysts and market commentators. So we started in South Africa in 2019, and we have invested for the last 2 years. And moving on into the performance, I'm sure that's what everyone who is invested in South Africa Fund is waiting for. We outperformed the JSE All Share Index, which is the benchmark for South Africa companies. So there are about 350 companies in South Africa listed space, from the largest one, Naspers and Prosus, which represent about 20%. And then you have British American Tobacco, you have MTN, and lots of other companies. So that's the JSE All Share Index, and we outperformed that. And then below the JSE All Share Index, we have the MSCI EM Index. So what the MSCI EM Index is the emerging market index for the global companies. So companies in China, in South Africa, Brazil, and also all the other emerging markets countries are within the index. So any investor who wants to invest in the South Africa fund should be benchmarking with how the South Africa equity market has performed and also how the emerging markets has performed. So we outperformed both in 2020, so that was the first year, and also this year, the fiscal year 2021. So I know 2021 has not yet ended, but the reason why we have 2021 is because our fiscal year started in October, so ended last month. So we started October, ended October, so that's our year period, that's our annual period. So overall, since we started, we've returned 71% and we have annualized 31%. And then in the past year, we returned 48.7% overall, whereas the JSE All Share Index was 21%, and the MSCI EM was 13%. So the MSCI was doing much better before, but there was a reason why it dipped towards the end, and that was because of China. So the Chinese economy has had a lot of volatility, some fundamental, some just speculation, and some just market noise. And there's been a downturn in the Chinese stock market. I mean, we'll talk about this later on, but that's why the EM didn't do better than the All Share Index in the second year. So I'm glad we were able to deliver for our clients, but the South Africa strategy has now been stopped. So now we'll only be focusing on the global strategy, and everyone who invested in the South Africa fund has gotten their money back in pound terms. So I'm glad and thankful to everyone who invested with us when I did reach out in 2019. And a lot of them have moved into the global strategy. So just a review on how, just checking the time. Yes, just a review on how we performed in terms of the fund. So our top three gainers was MTN and Karoo, and that's not a mistake. It's actually a company called Karoo. They're actually called CarTrack, and what they do is fleet telematics. So if you think about South Africa and Nigeria, it's quite industrial and the crime rates are fairly high. So what a lot of industrial companies, so think about Dangote and Heineken and lots of those industrial companies, they put fleet trackers in their trucks or logistics, and also consumers can also put it in their cars, and it allows you to track your car from anywhere, from your phone. So if you think about it, it benefits from, the crime, violence, and industrialization that occurs in Africa. And CarTrack is the market leader, and they've done very well. We returned about 100% on 108% on our investment in CarTrack, and then we sold all of it after it went up, and then they switched into a primary listing in the US, and then we sold our shares. And then we also have PBT Group, which is a small cap consulting company based in South Africa, but they also have global clients in Australia and also in Europe. So they're a consulting company that focuses on data or digital transformation. So just think of data analysis. They help out lots of companies with that. And funny enough, one of their clients is actually MTN Group, which was our largest position and the best performer. And MTN, I mean, last year, MTN was one of the worst performers, and that was because it had fallen by 70%. And the market thought MTN was going to lose all its value because of the oil prices. But it turned out later on that MTN was actually the beneficiary of COVID-19. And that was because MTN has three main businesses. Voice calls, so people not being able to travel, we're spending more on voice, and also the internet. So they have about 270 million subscribers, and I think about 40–50% of that are internet users within MTN. So they provide internet services for data subscribers, and they benefited from that as well, people being at home and browsing the internet. But the third and most important bit is the fintech area, which is mobile money. And if you know South Africa, not South Africa, but the rest of Africa, the banking industry is not very solid. So people look for alternatives in terms of being able to send, transfer money. And that sector is actually, I would say it's more advanced than what you'll see in Europe. So the mobile money industry in Africa is top notch, and MTN is the second leader there. And Momo, that's what they call their mobile money division, has been doing very well. And they're probably going to spin off their assets into another company. And since then, after MTN has done quite well. We returned about 140% on our investments in the second year after the 70% fall. On the decliners, we had three main decliners, Naspers, which owns Tencent. So they own the 30% of Tencent, which is where the bulk of their assets come from. And again, we're talking about Tencent. They haven't been doing very well because increased regulation and government oversight by the Chinese government on the monopolies of Tencent and the large companies like Tencent and Alibaba. So that didn't do well. And then also we had Impala, which is a platinum miner. We held that asset for too long and we should have sold it quicker. We have now sold it. But Impala is one of the platinum companies and platinum miners in South Africa. We made money on it in last year, but this year we lost money. So that's how cyclical the market moves at time. And the Merafe is a chrome resource miner. And we held it for 3 months and it was a 3% position, but we lost quite a bit because we were too late in the chrome cycle. So that's the lesson on investing in miners. You have to do a bit of timing, which is outside what we like to buy, growth companies. So those were that was the overall performance. And I mean, if you want to see all the companies we invested in, you can go to our website and our fund fact sheets are there. So moving on to the second and main fund where we have majority of our investment assets in, that's the global strategy. We launched the global strategy in September. So the South Africa was in October, whereas the global was in September. So it's September to September. So we've been 1 year and 2 months, but for the sake of the annual conference, we'll be using the first year. So we started the global strategy last year and we've been doing it for a year. And I mean, the goal is 15 to 25 companies across the world. So we have companies in Poland, in Sweden, in the US, in the UK, in lots of different areas. And now we've just invested in a company in China. I wouldn't be talking about them today because it's after the reporting period, but we invest globally. And I mean, the great thing about investing globally is that you have more options. So you're not tied, like South Africa, we were kind of forced to invest in the miners because that was what was available. But when you're global, you can really pick and you can be picky about what you want. So 25,000 companies we can invest in, and we're only aiming to invest in 15 to 25. So we can be really picky and say, we don't like that, we like this, we like that. And we can be picky with what we want. And in terms of the performance, we had a good first year, could have done better, but was good. We outperformed the MSCI World Index, which is all the companies, 2,000 plus companies, the MSCI regard as significant into the benchmark. So your Apple, Facebook, Tencent, they all are represented in the MSCI World Index. And then the less relevant benchmark is the FTSE All-Share Index, which is just for the UK. So this is mainly for our UK investors who want to know how we're performing relative to the UK. But for the fund, we mainly focus on the MSCI World Index because that's a true benchmark in terms of how we're performing globally. So we outperformed by about 4%. We started in September again, and we used the mid-month data. And just moving on really quickly because of time, this is how we, is our main contributors to the performance and detractors. So if you've read any of our reports, you'll know I'm very optimistic about the gaming industry. And one of the best performers was Evolution Gaming. And they're slightly different type of gaming company from the ones we normally talk about. It's in iGaming, and that's in live casino. So if you think about 15, 20 years ago, people who gamble or go to casinos, so think of Las Vegas, Macau, in South Africa, think of Sun City, you go to the actual casinos to game. But what Evolution Gaming do is that they build live casinos. So it's all on your phone. So you just game on your phone. They have operators, so it feels extremely realistic. And they have their studios in Malta, and they make so many games. So Blackjack, Monopoly, and they actually own all the IPs for these games. And they're an operator, so it's B2B2C. So they don't actually give the games to the consumers, they give it to the operators who then give it to consumers. So if you're in the UK, you can think of Bet365 or Ladbrokes. They all pay Evolution for their games on iGaming. So I think it's a terrific business. It has a profit margin of 60%, is debt-free, is growing 60% per year, and was the largest company on the portfolio, and it's done very well. We also had Garmin. Garmin, 10 years ago, Garmin was more well known for the GPS in cars, but today they make smartwatches, and they make smartwatches, outdoor devices, marine devices. They still have their auto device section, but it's much smaller. Then 10 years ago was about 50% of the business, now it's just 10. So it's mainly the smartwatch. Now, the way I describe Garmin to people, so there's Fitbit, which is also well known. There's Apple Watch, which is the one I have, and there's a Garmin. And so the way I see it is the Fitbit is like a Toyota car. The Apple Watch is like a BMW. And then Garmin is like a Porsche. So just say it as the premium side of smartwatches. I mean, they're more expensive than Apple Watches. They go for at least £350 per watch, and some go for 2,000. And they're mainly for the athletes that really care about tracking their time swimming or their time cycling. And you can do all sorts of things on the Garmin. So some of the Garmin watches are solar powered, so you don't have to charge them. You just go, I don't know, you walk around in the sun and it charges on itself, which is amazing from an environmental view in terms of being able to limit your emissions. It's great. And then the last one is Medifast. They do two things. So they're a meal kit company. So if you're thinking about maintaining your weight or losing weight or being on a diet, Medifast are the fastest growing company in that area in the US. And they also have operations in Singapore and Hong Kong. And they also have a coaching community. So what Medifast have done over the last 4 years is that they've transformed their business. So I think Herbalife is the more popular competitor to Medifast. But what Medifast do is that they realized that people want to train with other people. So going to the gym alone is quite boring. I find it quite boring. It's going alone. But what Medifast realized is that there's a way you can build small communities between coaches and maybe 3 or 4 people. And then that way you have that support from coaches, from other peers, and you don't have to be in the gym. It could be in the park, it could be anywhere. But they're very small communities. And they realized it was a much better model than what Herbalife do. So they're quite new with that Optavia. It's called the Optavia plan. And it's grown 50% every year for the last 5 years. And I mean, it's done quite well for us as shareholders. And we're very optimistic about Medifast. In 2020, it was the second growing fastest company in the US, according to Fortune Top 500. And more recently, made about, I think it just crossed $1 billion in annual revenue. 4 or 5 years ago, it was about 250 million. So it's growing very fast, and we really like the brand. And it's building a very good brand. And then on the negative detractor side, we had a few losers. So a few companies that lost us money. For 2 of them, TeamViewer and Stillfront were my mistakes. And we've sold them now, but we learned a huge amount of lessons from them in terms of while we were owning them. So TeamViewer, just to keep things short, they do remote desktop. So let's say you're in the UK and your computer breaks down, but the diagnostic team are in Japan and you need them to fix your computer without actually coming to COVID. So TeamViewer are the largest company in that segment. So they do a remote desktop software that allows people to operate your computer from anywhere in the world. And it's not just computers, any internet connected device in factories, supply chains, they do all that. And it's an amazing company, but we were too optimistic on the growth, and we didn't forecast the entrance of Zoom and other competitors. So a lot of companies that were not actually in the remote desktop market are taking market share from TeamViewer, and it's hurting them. So since we sold the shares back in July and we bought InMode instead, but it wasn't a good hold, and we've learned quite a bit. It's really important to be careful of competitors that are not in the immediate sector when you're investing in technology, because sometimes businesses just switch business models, and then today it's not a competitor, but tomorrow it becomes a very big competitor. Stillfront is a gaming company we invested in, and they focus on mobile games. So with Stillfront, I mean, Anna and I, we worked on this for a very long time, and it was a good investment up until Q2 this year. So they weren't reporting on their organic growth. So one thing many gaming companies do is that they buy other games and then it allows them to grow. So Stillfront were buying games, but it wasn't organic growth, it was inorganic growth. And so they were growing by acquisitions. And then from Q2 this year, they started reporting on their true organic growth, and it was much lower than what we had assumed. And I mean, the shares fell and we were able to sell it really quickly, and they're now off the portfolio. And just to keep things short because of time, Balco are a balcony provider in Sweden. We like the business, we still like the business, and we sold it too quickly. So since we sold it, the shares have returned about 35%. So yes, we sold it too quickly, and that was again my fault. And but I mean, it's an amazing company. It's still on a short list, but we lost a bit of money on Balco. But overall, we gained 27%, which was a good first year. And we're excited about the opportunities ahead of us. So yes, the lessons for 2021, 4 things to keep short. Differentiate between the organic growth and the inorganic growth. And I was talking about Stillfront, where they were growing by acquisitions. It's very important we differentiate from that, and we are aware of it. And then the second thing is opportunities can be found even in areas you don't really expect opportunities to be there. An example is paper. So, I mean, the last 15 years, paper has declined every year because people don't use magazines or newspapers as much, they're writing less, and they're using more of iPads. But in South Africa, there was a company we looked at that makes paper and packaging products. I wouldn't say the name so you don't go and buy the shares, but they make paper, and the market had been too pessimistic on them, but they were able to grow. And this year they've returned almost 300%. And I mean, paper isn't an obvious area to look for an investment opportunity, but I mean, there were opportunities even in paper. So it's really important to also look out for those opportunities in cyclical, deep value, or old economy sectors. Third is that technological advancements continues to transform old economy sectors. So now everyone is excited about, Tesla and NVIDIA, those technology companies, but it's important we also look at the old economy and the ways technology is transforming their business operations. And then the last one was actually Anna's idea, was to look into healthcare. And the problem I've had with healthcare in the past is that it's been very difficult to find moats because they're very heavily reliant on patents and those sorts of things. And someone can just come up with a new invention and it disrupts the whole healthcare business. But what we've learned is that it's possible to find moats in healthcare. And you look at insulin, which is needed for diabetes treatments. There's a company called Novo Nordisk, and they've been operating for the last 60 years, and they've built a huge market share in the diabetes insulin industry. In clear aligners, so people don't wear braces that much, they wear clear aligners. There's Invisalign, which has a huge moat in that industry. And I mean, in the last 12 years, the share price has gone up 100 times. They're very profitable. So we're also seeing opportunities in healthcare, and we're investing more in healthcare over time. So yes, like I said, we are now at the end of the investment club stage of Jenga. So we wouldn't be reporting, I wouldn't be spamming your LinkedIn or your Instagram as much as I normally do or I used to because of the regulations. So we going to move this here. So because of the regulation, we can't publish what we're buying, what we're selling as much as possible. So we are transitioning into an FCA authorization process. And luckily we have a great team of companies helping us out. And it's going to take about 6 months. And within the process, it's really important we invest in our infrastructure, our people, we hire good talent, and we really build a culture that allows Jenga grow for the next decade. So for me, I have, when I think about Jenga, I think I have a view looking 3, 4, 5 decades into the future. Hopefully I live that long, but it's a very long-term horizon. So our goal is to really build for the future. And then the next one is to relaunch the global strategy. So we're going to keep all the rules the same, but we're just going to relaunch it as an FCA authorized company in either Q2 or Q3, depending on when we get the FCA authorization. And if we do get the FCA authorization. And last but not the least is to continue delivering performance and doing better than the benchmark most years for you. I mean, we wouldn't always outperform the benchmark, and sometimes it might underperform, but it's all about the long term. So we want to outperform in 5 years' time, well above the benchmark. And I mean, that's what keeps me really happy. That's what keeps me motivated. And that's what keeps me driven about, building Jenga and doing it with people like Anna. That's what really keeps us driven. So we want to keep delivering that performance for you as our clients and partners. So we are almost at the, I've been talking for so long and I'm sure you're all bored of my, of my voice, but we're at the last stage of our presentation, which is the key themes for the industries, or the key industries and the key themes we're seeing in the next few years. And so on the top, we have gaming. I mean, I've spoken about gaming leisure. In one sense, the trend has been the world has moved from working 60 hours per week to working 35 hours. And what has happened is that we have more leisure time. I mean, just think about it. The average person works 9 to 5. And if you're like me, between 12 or 1, you're going to have lunch, you're going to go to Starbucks, you're going to drink coffee, you'll be on your phone, checking Twitter and Instagram. So you're still spending some time in leisure. But when you come home, you're going to do leisure, you're going to take care of the family, you might watch Netflix. Last 3, 4 weeks, you'll watch Squid Game or some series, and you spend time in leisure, and that's a beneficiary. It's growing really fast. The gaming industry now is about $230 billion. We're seeing lots of great opportunities in the gaming industry, so it's going to be a big theme for us. The second one is the creative economy. And what's happened is that people want to tailor things for themselves. And that role of personalization, of creativity is increasing every year. So a short example, Etsy. I scroll on Etsy for a very long time to look for inspiration for things. That craft, that focus on creativity is really growing. And people set up shops on Etsy where they sell certain things they've made. And I think it's going to be a growth market. And we're seeing lots of investment ideas, even beyond Etsy, in that creative economy. And that leads on to the gig economy. And I know the gig economy is kind of synonymous with Uber and ride hailing, but it really goes beyond that. So one of our most previous investments called EXP World, they are a real estate brokerage company. And what they do is that the old model, if you want to be a real estate agent, you'll go and find a broker and you go and work for them. And what EXP do is that they build a software and they realize there's actually no need for the brick and mortar. So you just get a software. They help you with so many things on, real estate software. So connect you with potential clients, build the infrastructure for you, build an email service for you. And it's always in the software, brick and mortar. So you can be your own boss. You can be part of the gig economy, an agent, where the fees are shared. The fees are given to you. I think about 60% is for you, and then some will be for EXP. And that's a huge trend we're seeing in many sectors beyond real estate. We're seeing Medifast again, the support coaches, that's the gig economy. We're seeing it in so many sectors. So we see it as a growth market. And the last three, I was talking about technology's application in all economic sectors. So there's so much technology going on, semiconductors, people using AI to understand personalized services. And with personalization, they're able to sell more things, price their services a lot better. There's so much technology change is growing, and it's going to keep growing. We're so bullish on the technological advancements. But what we've realized recently is that investing in technology doesn't necessarily mean you have to invest in technology companies. You can also invest in old economy industries and also benefit from that technology theme. And an example is actually Tesla. So cars is not new. Henry Ford, Mercedes-Benz, they all created cars back in the 1920s. But what Tesla have done with electric vehicles and partially autonomous driving is that they've brought technologies in AI, in the battery system, in being able to build electric vehicles and chemical-powered batteries. They've been able to use technology to transform the car industry. And you think about retail, Amazon, you think about fintech, you think about Square with Cash App. There's a huge amount of technology that would be transforming old economy. So even the next future, you'll see more innovations in construction, in real estate, and we're bullish on that. The last two, I'm going to leave 10 minutes just for the questions, or hopefully we can extend that. But the next two, health. COVID, look at COVID. If you look at the previous pandemics, so two other pandemics that have happened in the last 120 years, never could it have been imagined that we'll be able to produce vaccines that, they are currently working within a year or two. And that's where technology that's where you bring the technology field into healthcare. And that's something that's really transforming healthcare with genome sequencing, with being able to create healthcare devices. And one of our investments in healthcare is InMode, and they are in the medical aesthetics industry. And what they do is something that would never have been able to have done in the next, maybe 40 years ago or 30 years ago. And what they do is that they bring laser. So just think of, you want to do skin tightening, or you want to remodel your face or rejuvenate parts of your body, or skin contouring. You use certain devices, and usually it's laser or optical energy you used. So what InMode do is that they bring in radio frequency energy, and they merge that with laser energy, and that allows the devices to go much deeper into the skin, so they can bond fat cells much quicker. And they also have technological temperature-based devices that allows it to monitor the temperatures, so it doesn't overburn your skin or overburn your fat cells. And it's minimally invasive. And of course, you think about people wanting to look much better, people using more of social media and being more aware of how they look. InMode benefits from that. And it also benefits from women wellness, where the devices you can use the applications of the Morpheus 8 InMode device in vaginal rejuvenation. So, it's something you could have done 20 years, and that's a healthcare device that's transforming the world. Same with fitness. You look at Peloton, being able to gym at home and join communities, so many investment ideas. That said, I don't recommend some of these companies I've mentioned, because some of them are overvalued, without naming names. But yeah, that's an outlook for the future from a theme technology view. And now we have the last segment, the Q&A. I'm thankful for being with us for this long. So I will kick off with some questions. Yes, feel free to send any questions into the chat. If you have any questions, feel free to send them into the chat. I should have said that earlier, but we received lots of questions before the conference started, and I've put 3 of them here. And I've also written some of them down that I'll be able to read to you and answer them, but please feel free to put in your questions on the chat. And you might have questions from the presentation, or you might have questions from the questions already in the chat. Please feel free to send them. I'm more than happy to answer them. I don't have any script, and I haven't told my friends to send me the obvious questions. So this is pretty much impromptu, so keep it easy on me. But the first one, how are the Jenga portfolios prepared for an inflationary environment, which I think is a really, really important question right now. So regardless of what you're investing in, bonds, real estate, equities, stocks, even crypto to some extent, you have to be thinking about inflation right now. And the way I think about inflation is that there's a two-way side to look at things. There's the demand side of things, and there's the supply side of things. And with demand, the inflation has been a V-shaped. It's been, we didn't predict this was going to happen. But in the demand side of inflation, it's been a V-shaped, where when COVID happened, people were saving a lot more and were pulling back on spending things. And then you had central banks printing a lot more money and buying a lot more bonds and a lot more you also had lots of schemes to support consumers and people with grants and all these sorts of things, trillions of dollars put into the financial economy. And that happened meant that people had a lot more disposable income, and they were able to spend that on consumer goods, consumer services, B2B services. So the demand side of things, we've seen some inflation where demand has pulled, prices a bit forward. I think the supply side right now is slightly a bit more important to focus on. And it's where the world has had supply side shocks. And that's because of COVID again. If you think about COVID, it's been very disruptive in how we do things. And if you want to understand how disruptive COVID has been on the supply chain side of things, just try ordering goods from China and compare it to the price of ordering them 2 years ago. And I can show you the price of just transporting things will have more than grown sixfold. And that's because ports are stranded. In the UK, truck drivers have pulled back. Companies are having a lot less money a lot less allocation to give towards, improving the speed of their supply chain services. So there's been both demand side and supply side. And that's when you look at inflation around the world, you're seeing things of 5, 6, 7%. I don't know if it's going to be transitory or permanent. My gut feeling is that it's going to be transitory, but with a 1 year, 1.5 year view. But we've got to be thinking about inflation. And from a more equity investment, how that's then affecting the Jenga portfolios, there's a two-way side of things. One is there could be an interest rate rise. And in an interest rate rise, the stock market doesn't benefit from that. So when interest rate goes up, the stock market becomes a lot more a lot less attractive because of the discount rates in the future. But that said, there are some companies that can not benefit from inflation, but they don't get hurt from inflation. And there are two types of companies. The companies that can innovate in response to increased consumer spending, and the companies that can raise prices because of the brands. So we always talk about brands, and you think about the best example, luxury brands like LV, Louis Vuitton, or Gucci. They've raised prices 3 or 4 times this year. So even if inflation is 6%, they're able to raise prices 8% because of their brand strength, or because in Amazon's case, where they're able to innovate and increase supply or increase quantity, they can still withstand some of that inflationary pressures on consumers. So for us at Jenga, we're really laser focused on ensuring that the companies we're investing in have that power to raise prices, that pricing power. And I believe that to a large extent, the current portfolio has. So we have L'Oreal, which has raised prices on some cosmetic products within skincare and hair care. We have Kering, the parent company of Gucci. We have Evolution, which has raised prices for their customers, like Ladbrokes, but not all of them are able to do that. So we'll be interested to see which will be able to and which couldn't. So I hope that gives you a very broad perspective of how we're thinking on the inflationary environment. And then the second one, markets overvalued today. I don't like to comment on the overall company market valuation, but from a top-down view, there's definitely pockets of overvaluation, and we've missed out on a few companies that I really admire. So Tesla, Nvidia, and Tesla and some other companies. And in some cases, they're just outright overvalued. I thought Peloton was overvalued in January. Now it's fallen by about 40%, and it's looking a bit more attractive, but still not yet attractive. So we had a lot of sectors that benefited from COVID. They had a pull forward in their share price. The share price went 100%, 200% up. And now it's quite obvious they're overvalued. So I think there are pockets to really stay away from. And then also you had things like SPACs, where an entrepreneur or a financer will create a blank check of maybe $100 million. And the goal is to then merge it with another company that's private and take them public. So there was a huge greed going on in the SPAC markets in Q1. And if you look at a lot of the SPACs, we didn't invest in any SPAC, by the way, but if you look at all of the SPACs now, they've all fallen below where they're listed for. So the areas of overvaluation, but at the same time, there are areas where things are undervalued. And that's why we invest in places like Poland and Sweden and lots of different countries, and really doing the extra mile to find companies that can grow, have high quality, have high margins and profitable, have the pricing power, and at the same time are undervalued, both from an intrinsic valuation and also relative valuation. And the last one, a very touchy topic, cryptocurrency. Is Jenga allocated to the cryptocurrency assets? So we are an equity fund, so we can only invest in companies. I don't see that changing over time, but we only invest in companies. But we can invest in companies that benefit from decentralized finance, cryptocurrencies, and tokens, and all this stuff. We can invest in companies that benefit from that are public. So an example is Coinbase. There's Hive blockchain, which mines Ethereum in certain geographies, especially in Canada. And one thing I do like about Hive is that they have a huge focus on powering all their mining services with green energy, solar panels. So we can invest in cryptocurrency assets, but the problem is I don't have a view on where cryptocurrency is going to be, or cryptocurrencies like Bitcoin, Ethereum. I have no view on what's going to happen in the next 1 year, 2 years. So I'm never going to speculate on the price of these things. But what we can do is that we can invest in, the Coinbases and the companies that earn cash flow from cryptocurrency assets. So some of them I do like. And I also see an opportunity or an investment case, not necessarily for Jenga, but for anyone looking at private markets. I also see the opportunity in NFTs, and also in those cryptocurrency tokens or assets that allow maybe influencers or creators to monetize their assets, their IP a lot more. So it's an area I'm looking quite deeply into in terms of research and just trying to understand how things are. But at the moment, I have no view on what cryptocurrency assets are going to do in the next months. I don't know what it's going to be like in the political aspect of things. So Yeah, I'm not going to be forced to give a view on the price of Bitcoin in the next 1 month. So yeah, that's something, that's our view at Jenga. And I think Anna would agree with me. So just moving to the questions that you sent. So the first one, how has your investment process changed over the last few years? The short answer, it hasn't changed over the last few years. It's been the same thing. What has changed is where we look for opportunities and the amount of creativity we put in a process. So we are still going to look at the annual reports, speak to suppliers, speak to competitors, form our analysis on the company, but the creativity we add in how we analyze management has changed, but the process is still the same. The second question, how can a person invest in Jenga? So we've closed the investment club to new investors. So if you haven't already invested in the investment club, now it's too late to invest in the investment club. But after we transition into an FC authorized fund, for the first few years, we're likely to be limited to just high net worth individuals or institutions. So pension funds, family offices, funds of funds, hedge funds, those sorts of companies are the ones who would be allowed to invest in Jenga in terms of the global strategy. So, but hopefully in the next few years, we'll be able to open an open-ended unit trust where anyone can buy Jenga unit shares and then invest with us, but it's still many years in the future. Do you look at funds beta to these indices? Yes, we do, but it doesn't have an impact on what we buy or sell. So we look at these things just so we know them, but not because we're going to make a decision. And that's just because, I mean, beta measures volatility and that measures risk, and we feel risk is a lot more complicated than what the beta is. And just to give you a short example, Evergrande, which was the largest real estate company in China, had a fairly high beta, but it wasn't high enough. But people said, yeah, it's volatile, it's risky, but not very risky. Now, the problem is when you look at the company really relative to the risk, and you look at the debt level, you look at how heavily acquisitive they are, you realize this is actually much more risky than what the beta or the volatility is telling you. And then you then look at a risk from a much broader perspective, and you then look at it from the indices view. And some cases, some companies look more risky, some look less. And that's why we don't really put it in the investment decision. Are you worried about an impending... I'm just going to use 5 minutes. We've gone above time, so it's just going to be 5 minutes. So please send this question now quickly. But are you worried about an impending downturn or reset in the global economy? And do you think the Jenga's portfolio is positioned? In the short term, we're not positioned. We don't try to be positioned in the short term. So we don't try to limit the losses we make in a day or in a week. So I can give an example. Last year, when COVID fell, the market fell minus 33% in South Africa, and the Jenga portfolio fell minus 17%. Were we worried? We were worried on behalf of our clients, but were we worried personally? We were not worried at all. Why we weren't worried was because of the fundamentals and the facts. And when you look at the largest companies we own, like MTN Group, when we looked at the facts during the downturn, MTN that provides data, which people are going to be using more of during COVID or during the recession, was actually going to benefit from the downturn or from the recession. So that was fine for us. And we actually increased things as they were going up. So that's how we operate during a downturn. I mean, every downturn or every reset is different. Some is driven by the financial markets where things have been overvalued. And how we prepare for that is by not buying overvalued things. So there are lots of companies we like that we think are overvalued. So we avoid buying overvalued companies to ensure that if it's a financial market reset, we aren't exposed to things that are overly speculative but overvalued. If it's a fundamental economic downturn, we have to go back to the facts. Is it a pandemic? Is it a financial crisis like 2008? If it's a financial crisis like 2008, we're going to look at the real estate market. We're going to avoid, right now we don't own anything in real estate, but we're going to avoid owning things in that market and things that would clearly be impacted by the fundamentals and avoid them overall. So that's how we analyze, that's how we prepare for a downturn. I don't know if a downturn is going to come next week or month, but what I do know is that if there's a recession, people are still going to buy L'Oreal. Evolution's revenue is fixed, so even if all their clients go bankrupt, they have to pay them next year, which is good. Medifast have fixed contracts with clients, so they're still going to do quite well. And fitness will still be a strong thing even during a recession. So I would say on the fundamental and the long-term view, I'm confident in the Jenga portfolio overall. The Jenga lens, how does an asset get dropped from the portfolio? So two ways. Either the asset becomes overvalued because the share price has grown too much, or because we do more research and facts change on the company. So an example is TeamViewer. We initially thought it was undervalued, but we did more research on the company. And what we realized was that our growth estimates for the future wasn't accurate. So we sold that immediately. So two ways, either it's overvalued or is less than we think the fundamentals are not the facts that we initially thought. So the legal structure at first. So the next question is, what is the legal structure of Jenga? It's open-ended. It's going to be domiciled in the Cayman Island. And it's also going to have a master feed where US clients can also invest via a Delaware feeder fund. So that's the overall of the open-ended. So people can buy in or sell out monthly. And yeah, that's it. We have two more questions before we round up. Just scrolling down. What are your thoughts on the metaverse? Yeah, that's a good one. So we are invested in Facebook. At the moment, we don't really focus much on the metaverse in terms of analyzing Facebook, but we see the opportunity there with virtual reality. So two companies, Facebook make Oculus, the Oculus headsets in VR. And then we also have EXP, which is using themes from the metaverse to transform real estate markets. So normally, if you want to buy a house, you probably shortlist 10 houses. And you view them, you go for viewings across London to view them. What EXP do is that they've built a software called Verbella, where you can view houses on a virtual reality. And I've tried it before, it feels very realistic. And what that helps is that rather than viewing 10 different houses, you'll probably just view all 10 on your virtual reality headset. And then the last two, you'd actually go and visit them. From a cost view, from an efficiency view, you can see how the metaverse helps consumers and businesses. So I'm bullish on the metaverse from that view. It's going to drop costs for so many things down. It's going to, the technologies behind the Oculus, the gloves, and how realistic it feels are going to keep improving over time. Facebook are investing tens of billions of dollars into this, and I'm very confident on things growing. But I'm worried that the name metaverse is going to cause a bubble, so make things overvalued. So we're also quite careful on that. And the last question. So, okay, we have space for two more. South African miners, coal miners. So coal is something Anna and I debate, and we haven't yet come on a conclusion with our policy on investing in coal. So we looked at Thungela, we looked at the coal miner that was spun off by Anglo American. It was clearly undervalued because coal was out of favor, but I couldn't come to terms with if I want to invest in coal from an ESG point of view. We're still doing our research on this, and we're still forming our opinion on that. So we didn't invest in coal. But if you have coal, if you had coal in your in the things you could buy, then and you did buy it, then I'm sure it was a great. It's done quite well. So I'm sure it was a great asset to own. I don't have a view on at the moment where call is going to go. So, but I mean, we looked at it and we considered it as an investment, but we couldn't come to terms on if we want to own coal for the Jenga fund. And the last question, do you see factors, so value, growth, momentum, are cyclical? And if so, are you positioning for a shift from growth to value? So there's already a shift from growth to value. And so the South Africa strategy was positioned from a value factor traditionally, and that's why it did 48%. And then the Jenga Global Fund was more positioned for a growth factor, and that's why it didn't do as well as the South African fund. So there's already that shift going. But we're not too worried about shifts and factors because, I mean, we're more bottom up than top down. So we are aware of the factors, but then we use that to form an opinion on what the overall market is doing. But when we look for certain companies and to add into the portfolio, we're not worried on if the market is moving from growth to value to momentum. We're more focused on the fundamentals, the business growth, the profit margins, the competitive advantages, the growth rate of that company. And when we compare it to the rest of the other companies on the shortlist, if it's good enough, it goes on the portfolio. If it's not, it doesn't go. So we look at the factors and we're aware of the factors, but it's not something that changes what's on the portfolio. Yes, so I'm really, really thankful to everyone who's taking the time out on a Thursday afternoon, and also for those in the US. There are a couple of you in the US who are here on the morning time. I'm really thankful for the questions. I'm thankful for you joining us. More importantly, I'm also thankful for the people who have subscribed to Jenga briefings, people who invested in our South Africa fund and the global strategy. Without you, we wouldn't have the motivation to build Jenga. We wouldn't have the capital to build Jenga. And I'm really thankful that for the support in terms of your time, in terms of your money, in terms of your resources you've put into Jenga. And I mean, 2 years ago, I had the idea of this stage transitioning to an investment fund, but I didn't really think it was going to happen. But without you guys, without the support, we would not be able to do this. So I'm very thankful for the support you've all given us, and friends and family who've also been there for myself, and in terms of just giving us the support, the motivation. I'm also really thankful for that. And I'm really excited for the next year and the next 2 years and hopefully the next decades of Jenga. And I hope we're able to continue compounding the assets and the capital from our clients and beat the benchmark every year and be in the top 3 to 5% of all types of funds globally. And from me, I want to say thank you again, and thanks for joining the call. And if you have any questions that might not have been answered, feel free to drop me an emails. My phone replies are a little slow, bear with me, but send me a text and I'll get them answered to you. So yeah, feel free to send me a message, and I hope the rest of your